everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. Fed Watch cut to the chase. And after much anticipation, the Fed finally delivered a rate cut at the September FOMC meeting. And the amount, 25 or 50, had been the subject of a great deal of speculation of late. And the voting members decided on a half-point reduction to kick off this easing cycle. And that brings the new Fed funds trading range down to 4.75 to 5%. For the record, this easing move represented the first non-COVID related rate cut since October 2019. And with this first easing move now in the books, the money and bond markets will be turning their undivided attention to what this rate cutting cycle is going to look like. And in a data-dependent monetary policy world, that's going to leave plenty of room for further speculation for not only the remainder of this year, but for 2025 as well. And first up, the Fed not only cut the Fed funds target, it also went back to their prior dot plot, where further decreases are back again being forecasted for the final two FOMC meetings of this year. And this is where things could get interesting. For the record, right before the September convocation, implied probabilities for Fed funds futures were pricing in 100 basis points in rate cuts for this year. For the record, what the Fed has as well would probably match that now that they've started off with 50, and it looks like expecting perhaps two more 25s in November and December. And as I've written a number of times lately, the Fed's new data-dependent policy is designed to determine the pace and magnitude of future rate cuts. And against this backdrop, in terms of their dual mandate, employment has now surpassed inflation as the primary driver for Powell and Company. So as a result, the monthly jobs report has now taken on even greater importance, if that's possible. That doesn't mean the inflation aspect has gone away, though. Let me give you some perspective. At 3.2%, this was the highest year-over-year rate for core CPI to begin a rate cut cycle since 1989. All right, what else makes this rate cut cycle different for investors? The new rate regime. And the Fed funds trading range stood at a more than 20-year high watermark to start this easing process. In fact, Fed funds was 300 basis points above the level that existed to begin the pre-COVID 2019 rate cut cycle. Now, a key development I'm going to be watching closely as we move forward is whether there is a big disconnect between what the money and bond markets are expecting in terms of magnitude of rate cuts and what the policymakers themselves are envisioning. We've seen a disconnect scenario play out a number of times the last few years, and let's bring it back to that implied probability component. The market was expecting 10 rate cuts by Q4 of 2025 with a Fed funds target of 2.8%. Now, unless the labor markets visibly weaken and the economy moves into hard landing territory, this type of rate cutting activity does seem overly aggressive at this stage of the game. So let's get to the bottom line. Presently, this is how I'm looking at it. If future economic data, think jobs, don't reveal any signs of visible weakening, then this easing episode will be based on the concept that the current restrictive policy stance is no longer warranted, and Powell and Company want to avoid any unintended consequences, especially on labor market activity. And this backdrop would more than likely result in a more deliberate rate cutting phase. However, if the Fed were to see higher unemployment rates and weak payroll numbers in the months ahead, this would arguably create the environment for that more aggressive easing stance that I just mentioned. So that's it from here. I hope everybody has a great rest of the week and be well.